Trading versus investing. Which one is really more profitable? Hey everyone, welcome back. Today I'm going to answer a question you guys keep asking me. Trading or investing, which one is really more profitable? Let me ask you something. When you hear stock trading, what comes to mind? Probably that chaotic scene at the New York Stock Exchange, right? You know, everyone's shouting, phones ringing, prices changing in seconds. That's how things used to be. But now everything's different. Most trades happen online. And thanks to technology, regular people like us can try to make money from the comfort of our homes. But here's the thing. Trading and investing are completely different activities. When you or I buy a stock, that doesn't automatically make us traders. Being a real trader, whether professional or as a hobby, is very, very different from being an investor. And I know you constantly hear stories about people making fortunes from trading. But let me tell you this. For most people, it's better to stay away from trading. Why? Well, that's exactly what we're going to talk about today. Let's look at the basics, trading versus investing. If you look in the dictionary, the definitions of investing and trading are pretty similar. After all, they're both about spending money with the hope of making more in the future, right? But the real difference isn't in the definition, it's in the approach. An investor puts their money into an asset and waits for it to grow in value over time. A trader tries to make money from short-term price movements. So investing relies on gradual growth, while trading depends on market volatility. The two big differences. There are two main differences between trading and investing. Time and method of analysis. Let's start with the timing issue. 1. The time factor. Investing is generally long-term. Trading is all about the short term. When you invest in a company, you believe that company's value, its profits, assets, market position, will grow over time. You might hold that stock for 5 years, 10 years, even 30 years. Of course, prices fluctuate every day. Some investors might try to take advantage of short-term dips, but generally your focus is on long-term trends, not daily noise. Trading, on the other hand, is fast and intense. It's all about making quick moves based on short-term price changes. For example, day trading means buying and selling within the same day. Swing trading can last from a few days to a few months, sometimes even up to a year. Whatever the style, the goal is the same: profit from price movements in the short term. Traders constantly open and close positions, sometimes within seconds. But selling something quickly doesn't automatically make you a trader, which brings us to the second big difference: analysis. 2. The analysis difference. The way investors and traders analyze a stock is completely different. To understand this, you need to know the difference between a stock's price and its true value. The stock price shows what buyers and sellers currently think it's worth. But underneath that market price is an objective, true value, the stock's intrinsic value. Over time, the price should track this intrinsic value. But fear and greed cause temporary distortions. There are two main approaches in investing. Passive investors ignore short-term fluctuations and focus on long-term growth. They believe that since markets generally rise over time, buying a bit high doesn't matter in the long run. Active investors try to estimate a stock's true value. If they think it's undervalued, they buy and profit when the price reaches its true value. Both approaches are based on the idea that the company's value will increase over time, but traders don't care about true value. They only care about price movements. Some traders don't even know what the company does, and they don't need to. Their focus is entirely on charts, trends, and technical indicators. That's why you see professional traders sitting in front of 4 monitors staring at candlestick charts. They use indicators based on historical price data to identify trends and short-term opportunities. Some traders might also follow news or company events, but only to predict short-term reactions, not long-term performance. For example, if a trader hears that a company will announce good results tomorrow, they might buy today and sell at a higher price after the announcement. So while investors look at business growth, traders look at price movement. The reality of trading, and that's where the real difference lies: the mindset and environment. Trading is fast, competitive, and sometimes involves a bit of bluffing. Back in the trading floor days, people literally shouted over each other to hide their intentions. Even now, traders try to conceal their real moves. All of this makes trading exciting, especially for young investors. It's fast, competitive, and potentially very profitable. Add to that the social media ads from people saying, "I turned $300 into millions with a simple strategy." It's easy to see why trading looks so appealing, but in reality, trading is extremely risky. Most traders use large amounts of money, sometimes even borrowed money, leverage. This makes them vulnerable to even small market swings. It also requires enormous amounts of time, focus, and discipline. Many trades only bring in a fraction of a percent in profit, so traders must constantly enter and exit new positions. And to be honest, the odds aren't great for beginners. You're competing against hedge funds, institutional traders, and algorithms that can execute trades in the blink of an eye. It's not exactly a fair game. Sure, there are people who make a living from trading. There are even companies that employ full-time traders. So it's not all bad. But trading is a lot like poker. You can be very skilled. You can even make a living from it. But there will always be players at the table who are stronger, faster, and luckier than you. That's why most financial advisors will tell you this. For the average person, investing is the smarter path. Solid research, a long-term mindset, and steady exposure to economic growth. These are the keys to building sustainable wealth. Sure, it's not as thrilling as a triple leveraged call option, but if what you're after is high risk with low odds, you might as well go to a casino. At least there they give you free drinks. Final word. Thanks for watching today's video. If you enjoyed it, don't forget to hit that like button, subscribe to support the channel, and turn on the notification bell so you don't miss future videos. If you have any feedback or topics you'd like me to cover, write to me in the comments section. I'm Melly Gensel, and this is the Money Code MG. Thanks for watching.